Today, I want to talk a little bit about the RSU trap and also the GSU trap. And a GSU is called a Google stock unit. Well, really, they're the same thing. But when you get as big as Google, I guess you get to make your own vocabulary and rename ordinary things something extra special, so you don't forget where you got that from. Well, Google, otherwise I think it's known as Alphabet. You might have heard about that on the stock exchange. When you work for them, sometimes they'll issue you units of the company's stock. Isn't that wonderful? Why would Google do that? Well, I think they're trying to incentivize you to make the company do better. So as you work for them over a period of time, you get vesting rights and you eventually get the units coming through to you. Well, today we're going to talk about the tax implications of that and why you might be paying 100% or even more of your compensation in taxes. Doesn't that sound wonderful? Well, actually, believe it or not, I've seen a lot of tax returns come to me, especially by people who don't want to waste their money on those stupid, evil CPAs. They're always trying to charge them to do what they could just do on TurboTax themselves. Remember, you and a chimpanzee jumping out of an airplane with a parachute and a typewriter can be doing their taxes because it's just that simple, according to the TurboTax commercials, right? Okay, enough of that. When you get those stock options given to you, it's kind of like when Oprah gives away cars. She'll give you the car, but you got to pay the tax on it. Well, a lot of people don't remember ever paying any tax at all on their GSU or RSU. The reason is because it's hidden inside the W-2. So on box 14, it'll show the RSU coming across, but on box 1, your taxable income, that's where you see the tax. So let's say you're a high income earner working for a company like Google, and you end up getting the stock option, and you're in a 30% tax bracket. Because you love the government so much, you want to make sure you give them a good share of your income tax. Now remember, don't worry, 37% is not all the tax you pay, because you also pay an extra 7.65% of your tax towards Social Security and Medicare. So that brings you up to about a 44% tax bracket. So you'll pay an extra 7.65% in Medicare, Social Security tax, which go to fund not your retirement, but people's retirement who are currently retired today. Well, anyway, that's another discussion, but the more you pay in, the more you may get in the back end. So we're going to talk a little bit about how all the taxes add up. So if you're in California, I'm in Sacramento, California. I started my practice in Petaluma, California, and all kinds of people were getting paid in these types of stock options, the restricted stock units. So remember, you pay your 37% federal tax, perhaps, maybe 8% California, that brings you up to 45%. And then if you add on another 7.65% for your payroll taxes, pretty soon you're at 52% plus in taxes, right? Okay, so you paid all that tax, but because your employer took it out and it got kind of mixed in, you didn't know the reporting, hey, you're not a tax expert. Well, you ended up doing your taxes and you forgot that you ever paid anything for that. Well, let's say something happens and later you decide to sell these. Whether you're still working at the company, you left the company because you got laid off, AI took your job, whatever ended up happening. Well, hey, I got no job, I got no income. So let me go ahead and sell some of these and raise some capital so I can afford to move to where my next job is, or whatever this thing is. Maybe you want to diversify your portfolio. So you sell these, and when you get your statement from E-Trade or Merrill Lynch or whatever, a lot of times those companies have a big zero reported for the basis. You might be saying, what? Oh, right, I just got those given to me by the company. So you don't catch it as a person who's doing your tax return. Many preparers also might not catch it if they're unfamiliar with this subject. And because they put a zero on the tax return, all the proceeds come across as a taxable transaction. So let's say, for example, you got $100,000 in stock options. And by the time you sold $100,000 in GSU or RSU, it went up to $120,000. So now you're going to go ahead and calculate. Now, if you sell it in less than 1 year, you'll pay the normal tax rate and you pay short-term capital gains. And you could pay as much as that 37% tax. And California, luckily for us in California doesn't have any capital gains tax rate, which means you pay it all at the normal tax rate. Remember, the capital gains tax rate is a lower tax rate, especially for investors that the federal government gives you a break. California, we don't want to give anyone a break on that type of stuff, so we charge them the normal rate no matter what. Thank you, Gavin Newsom. So anyway, we'll take a look at these different rates, and when we add it up and you sold things, you paid almost 50% or perhaps more than 50% when they were first issued to you of that $100,000. And then when it comes across again through capital gains, you're going to be paying normal tax rate if it's a short sale or a capital gains rate if it's a long sale. You could be paying another 40, 45%, even 48% on those taxes by the time you add up the 52% or whatever you paid in the beginning plus the 42% later. Basically, you paid 100% of your income that you received in the form of RSUs to the federal government, state government. So what can you do? Well, if the transaction happened less than 3 years ago and you filed your taxes less than 3 years ago, you can still file for a tax refund. You can still get the money back. So if you worked at a company and you got RSUs and you sold stock too, you may want to have a second look by a qualified CPA. Feel free to contact me, Max Drew, your friendly neighborhood CPA, coming out of Sacramento, California. Be happy to check that out for you. Make sure that was done correctly for a no pressure consultation. But you have to do it within 3 years, and you can do that by amending your tax return. Okay, without getting too far into it, I just want to say GSUs and RSUs are a wonderful thing, but it sucks if you don't know what you're doing and you paid over 100% tax to the federal government and state government for your RSUs and GSUs. So if you're getting RSUs, GSUs, stock options, I recommend don't do your taxes yourself. Find a savvy, qualified CPA that's out there to help you and not help the government save as much of your hard-earned income as you earn and deserve. Max Drew, CPA, with your stock option tax tip of the day. Take care and have a wonderful rest of the week. God bless you.
Follow, message us, or scan the QR code on the screen to learn more.